Welcome to vTalkInsight, Risk Sentiment Daily for January 6, 2026. Global markets are pushing deeper into risk-on territory, with artificial intelligence, crypto, and geopolitics all pulling sentiment in competing directions. Today we unpack what is driving this optimism, where fragilities are building beneath the surface, and how that mix is shaping cross-asset risk appetite. Across major markets, the dominant tone is risk-on but fragile. Equities are grinding higher, volatility indices are sitting in the mid-teens, and cyclical sectors tied to growth and geopolitics are leading performance. At the same time, there is a clear bid for classic safe havens like gold, the US dollar, and Treasuries, which tells us investors are leaning into upside but quietly paying for protection. On the risk side of the ledger, U.S. stocks have rallied despite geopolitical turbulence, with the Dow hitting fresh records and sectors such as energy, defense, financials, and mining all benefiting from recent events in Venezuela. Asian equities are joining in, with major indices in Japan and South Korea up around 3% and lifting broader regional benchmarks to new highs. Crypto is firmly in risk-on mode as well, with Bitcoin breaking above its recent trading range and pulling related equities and options activity higher. Yet underneath that optimism, positioning shows late-cycle caution. Gold and silver are rallying strongly, central banks are adding to gold reserves, and investors are maintaining barbell allocations that combine high-growth exposure with treasuries and inflation protection. Macro risks from sticky inflation, large fiscal deficits, and geopolitical flashpoints are widely discussed but not fully priced, leaving a backdrop where sentiment is constructive, volatility is low, and the risk is that an unexpected shock forces a rapid repricing. A key bullish driver of sentiment is AI and tech-led growth momentum. Semiconductor and hardware names connected to artificial intelligence continue to outperform, with companies such as ASML and TSMC rallying on upgrades and robust demand expectations. Asian technology markets are particularly strong, helping push the regional benchmark to record levels and feeding positive spillovers into European and U.S. tech shares. Nvidia remains at the center of this story. Revenue growth expectations are being revised higher, with some forecasts looking for gains of around 65% on the back of strong demand and upside surprises from partners. New platforms like the Vera Rubin chip, which promises a step change in AI compute efficiency, and advances in autonomous driving, robotics, and so-called physical AI deepen the view that we are still early in a multi-year infrastructure build-out. Momentum also extends beyond a handful of mega caps. Open-source models and tools are lowering barriers for startups, and industry leaders expect AI-driven capital expenditure to accelerate through the next couple of years, with broader productivity gains starting to show up from 2026 onward. Strategists see the Nasdaq potentially outperforming traditional benchmarks by a meaningful margin, while equal-weighted indices are attracting interest as leadership slowly broadens beyond the original AI heavyweights. The main risk to this driver is valuation and capital discipline, especially if high-profile fundraising efforts or earnings fail to match the very ambitious growth narrative. The second bullish force is resilient risk appetite across assets. Despite heightened geopolitical tension, U.S. equities have pushed higher, with energy, defense, and financial stocks leading gains. Oil services names are posting their strongest rallies in months. Banks are benefiting from expectations of double-digit earnings growth over the next few years, and defense stocks in both Asia and Europe are being treated as quasi-safe havens in a more dangerous world. Risk appetite is just as visible in crypto and thematic exposures. Bitcoin has surged more than 2%, trading around 93,000, with Ethereum and other major tokens following. Institutional participation is rising, supported by improving regulatory clarity and the growth of listed products, while options markets are seeing bullish positioning that targets significantly higher price levels. In listed markets, multi-strategy and growth-focused ETFs tied to artificial intelligence, income overlays, and alternative assets like Bitcoin and precious metals are attracting attention as investors seek diversified ways to stay engaged in the cycle. At the same time, there are signs of selectivity that temper the exuberance. Utilities and parts of big tech and pharmaceuticals are lagging the broader market. U.S. shale producers are under pressure on concerns about a future supply glut, and investors are keeping one foot in safe havens such as gold and Treasuries. This combination of strong risk-taking and active hedging suggests that while growth and carry remain in favor, positioning could turn quickly if macro data or geopolitics break the current narrative of contained risk. The third supportive driver is the prospect of Fed easing and disinflation, even if the timing is uncertain. Monetary policy is viewed as close to neutral, and markets generally expect the next move to be lower rates once the Federal Reserve is more confident that inflation is on a sustainable path toward target. Expectations are skewed toward cuts in the second half of the year, with many participants looking to the trajectory of unemployment as the key trigger. Speculation around future Fed leadership adds to that optimism. There is a view that the next chair could advocate a more aggressive cutting cycle, with consensus centered on the possibility of 3 cuts rather than the current committee's baseline of 2. Equity investors in particular see a leadership shift toward a more dovish stance as a clear positive, while bondholders appear comfortable with additional easing if it is underpinned by stronger productivity and contained wage growth. On the inflation side, there are pockets of genuine disinflation. Fed officials expect housing services inflation to trend lower, given the lagged effect of softer new rents feeding into official measures. Looking slightly further out, anticipated productivity gains from AI adoption are seen as another mechanism that could help keep unit labor costs in check. The risk to this bullish narrative is that inflation proves more persistent than anticipated, forcing the Fed to delay or scale back cuts, a theme that increasingly features in the more cautious commentary. On the bearish side, sticky inflation and higher-for-longer rates remain a central concern. Price pressures are still running above target, and there is skepticism that they will fully revert while tariffs and supply disruptions exert upward pressure on goods prices for several years. Some analysts see U.S. inflation staying in the high 2 to low 3% range through 2026, which would challenge current expectations for a smooth easing cycle. This has led to growing pushback against aggressive rate cut hopes. Voices inside and outside the Fed warn that markets may be underestimating the probability of no cuts until at least 2026 if growth remains resilient and inflation sticky. Hawkish committee members are seen as reluctant to take policy rates significantly below 3% without clear evidence of economic deterioration, and some scenarios envision no meaningful easing from either the current or future Fed leadership. Layered on top are concerns about bond yields and fiscal sustainability. Persistent real GDP growth above 4% combined with inflation in the upper 2s could push 10-year Treasury yields higher, at odds with market hopes for lower long-term rates. A projected federal deficit of around $1.9 trillion and interest costs already exceeding $1 trillion per year raise questions about term premia and the capacity for the bond market to absorb heavy issuance without repricing. In this environment, rate-sensitive and highly valued assets look vulnerable if the higher-for-longer scenario becomes dominant. A second key headwind is underpriced geopolitical and macro shocks. The dramatic developments in Venezuela, including regime change dynamics and U.S. military involvement, have injected fresh uncertainty into energy markets and regional politics. While immediate spillovers to U.S. assets have been limited, there is a non-trivial risk of escalation, especially given the country's ties to Russia and China and its significant, if challenged, oil reserves. These events sit within a broader trend of deglobalization and great power competition. The post-war order is fraying, with countries prioritizing self-reliance over integration and technological decoupling between the U.S. and China continuing beneath the surface. Potential flashpoints include renewed trade friction as agreements are renegotiated and possible confrontation over access to Venezuela's rare earths and critical minerals, which some see as a materially underpriced risk to global markets. Market pricing does not fully reflect these threats. Risk assets remain priced for a near-perfect outcome, with equities, credit, and even crypto buoyant, and implied volatility low despite multiple shock channels. At the same time, gold and silver are rallying hard, Central bank gold demand is strong, and the US dollar is gaining on safe haven flows, signaling that more defensive capital is quietly moving to the sidelines. The danger is that a geopolitical or macro surprise forces a sharp transition from today's calm to a risk-off regime, catching crowded positions off guard. The third bearish driver is valuation and credit spread vulnerability. Optimism for risk assets is higher than a year ago, and many markets look priced for perfection against a backdrop of cooling labor data, persistent inflation risks, and geopolitical uncertainty. That combination leaves little margin for error if earnings, growth, or policy outcomes stray from the current benign consensus. Credit markets are a particular focus. Spreads remain tight even as some underlying fundamentals show signs of deterioration, and large banks expect U.S. investment-grade issuance to ramp up sharply, with forecasts of around $1 trillion of net supply in the coming year. Such heavy issuance could pressure spreads wider, especially if it coincides with higher real yields or a shift in risk sentiment. Sector performance also points to a maturing cycle. While banks, defense, and AI-linked names are enjoying strong rallies, pharmaceuticals, utilities, and U.S. shale producers are lagging, and equal-weight strategies are gaining attention as investors look beyond the original market leaders. The AI complex itself faces questions about where sustainable profits will accrue and whether headline names can maintain their pace of growth. If growth disappoints or policy turns less friendly than expected, today's tight spreads and elevated valuations could amplify, rather than cushion, any downside move. To sum up, global risk sentiment is still leaning risk-on, powered by AI and technology momentum, broad-based appetite for equities and crypto, and expectations that the Fed will eventually deliver an easing cycle supported by pockets of disinflation. Set against that are three growing fault lines: inflation that may keep policy tighter for longer, geopolitical and macro shocks that markets are not fully pricing, and valuations and credit spreads that leave limited room for disappointment. Watching how incoming inflation and labor data shape the Fed path, how the Venezuela situation evolves, and how AI earnings and fundraising milestones land will be critical for gauging whether this optimistic regime persists or gives way to a more volatile phase. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.